Last Wednesday, April 9th, the S&P 500 had its best single-day gain since 2008 after Trump announced a 90-day pause on the new reciprocal tariffs. Now, if you had pulled out of the market after the sharp declines over the week prior, you would have missed it. Now, market timing feels like a smart move when headlines get loud, but it often backfires. And the data's clear. Missing just a few of the best days in the markets can wreck decades of growth. Hi, I'm Jordan Lehman, founder and financial planner at True Wealth Retirement Partners. And every day I help my clients create steady retirement income, invest smarter, pay less in taxes. And I want to share what's working for them so you can retire with confidence too. So let's talk about something that sounds smart, but often backfires: timing the market. You know the feeling. A big news headline drops, maybe it's tariffs, an election, or a Fed decision, and suddenly you're wondering, should I pull my money out? It feels like the rational move, right? And you're making a decision to protect what you've earned, but here's the twist. Market timing plays to our worst instincts, often fear, or on the other side, greed. We get scared during a dip or greedy after a rally, and we try to outsmart the market by jumping in and out. But what actually happens when you do that? I want to show you something interesting. So, this is an awesome resource put together by my friends over at Dimensional Fund Advisors, and it looks at, for the Russell 3000 index, an approximation of the US stock market, the cost of missing the best days in the markets. And this is looking specifically from 2000 to 2024, 25-year period. So if you had $1,000 invested in the year 2000, it would grow in this index to just over $6,600. Not too bad. And that was you staying in, staying disciplined, not panicking when markets dropped, not getting greedy when markets ran up. You let your thousand ride in the index. And the question is, what if, because of market timing, remember, you have to be right twice. You have to know when to get out and then know when to get back in. So get this. What if you had missed just the best week? We're talking 5 days in a 25-year period. Now, instead of $6,600, you only have $5,500. Almost $1,000 less because you missed just the best week. Pretty interesting. What about the best month? You got out during the COVID crash and got back in a month later. Well, now instead of $6,600, you only have $5,274. The best 3 months, maybe you wanted to see how things played out again, the COVID crash here, see how things played out. And finally, 3 months later, you had your nerve and got back in. You stayed disciplined through the tech crash, through 2008. COVID, you lose your nerve. $6,600, how about $4,600? Amazing. Just 3 months in a 25-year period. 6 months, even worse. It's amazing how being out of the market for these best periods has such a dramatic impact on your total return over such a long period. So, what do you actually do? You stay invested, you stay diversified, you build a plan based on your goals, not today's headlines. Trying to time the market because of political noise, whether it's tariffs or elections or Fed moves, scary. I get it. Although it usually leads to one thing: regret. I called one of my clients this week and they said, we're not going to make the same mistake we did in 2020. I said, what was that? They said, we got out and we missed out on the return or the upside. And yes, there's some nervousness with what we're seeing in markets. Yes, it's not fun seeing account balances fluctuate. And they said, we're not making that mistake again. You end up chasing returns or sitting on the sidelines when the market recovers without you. That's the danger. So if you're feeling anxious about the news, ask yourself this: am I making a move based on my goals or based on fear? Because when it comes to investing success, time in the market beats timing the market just about every time.